I started investing when I was just 11. At first it was thrilling, chasing the quick gains, timing the market, obsessing over every chart. But those years? Mostly a blur of speculation and frustration. Sure, it was fun, but never profitable. And as the years passed, I couldn't shake the feeling that I was missing something crucial. At 19, after dozens of books and countless failures, I finally stumbled upon The Intelligent Investor by Ben Graham, first published in 1949. This wasn't just another investing book, it was the revelation I needed. The simplicity of Graham's philosophy was deceptive. Its power came not from complexity, but from the clarity and practicality of the principles he laid out. There are three core ideas from this book that reshaped my entire approach to investing. The first, a stock isn't just a ticker symbol, it's ownership in a business. For years, I knew hundreds of ticker symbols, but didn't understand the businesses behind them. Graham taught me to ask, what's the business really worth? What's its competitive edge? How solid is its management? Suddenly, I wasn't just looking at numbers, I was looking at entire ecosystems of companies. Then there's Mr. Market, an unpredictable, manic, depressive character who offers to buy or sell stocks at wildly fluctuating prices. What struck me was this: you don't have to listen to him. You don't have to react to his mood swings. If you can stay calm while Mr. Market dances between manic highs and despairing lows, you can wait for your opportunity to strike when the price aligns with the real, intrinsic value of the business. But there's something more chilling that Graham warns about. The volatile price swings in the stock market aren't the true measure of a company's value. They're just noise, which brings us to the final, perhaps most important lesson: the margin of safety. Imagine you're walking across a bridge. The posted weight limit is 10 tons, but you only have 9 tons to cross. That's safety. In investing, the margin of safety is your cushion, buying a stock at a price significantly below its true value, so that even when things go wrong, you're protected. But how do you find the right stocks? How do you narrow down the thousands of potential options? Here's how I now screen for investments. Look for companies with an economic moat, something that keeps competition at bay, a strong brand, patents, an unshakable market position. Coca-Cola, for example, doesn't just sell soda. It dominates through a global brand that's impossible for competitors to replicate. Trust the leadership. A business can withstand poor management, but it's far more likely to thrive under leaders who are not only capable, but ethical. In the end, the best businesses are led by the best people. And of course, price matters. You can't overpay and expect long-term success. The key to wealth is not picking the best stocks. It's eliminating the bad ones, the losers, the dangerous competitive businesses with no long-term promise. Imagine this: you're handed a punch card with only 20 spots, 20 investments in your lifetime. What would you choose? This is the mindset you need. Investment decisions shouldn't be impulsive or rushed. They should be thoughtful, strategic, and based on research. You don't need to make hundreds of choices. Just a few smart ones will set you on the path to wealth. The lesson is clear. When you focus on the fundamentals, on the businesses behind the stocks, on understanding market fluctuations, and on maintaining a margin of safety, you position yourself for long-term success. The market's daily noise will come and go, but true investors, we're the ones who stay the course. And with the right strategy, we can build wealth that lasts.